Hello, welcome to the online classroom for the modules MBL5903 and MBA5903, Strategic Financial Management. In the previous class, I started looking at capital budgeting cash flows, and we looked at a number of examples from the MBA 5903 assignment with regards to capital budgeting cash flows. Like I said before, capital budgeting cash flows involve a lot of calculations involving depreciation and tax, so they can be a bit intimidating. Traditionally, they haven't been asked a lot or even at all in assignments and exams, but the professor this semester decided to ask them significantly in the assignments, both the MBA assignment and the MBL assignment. So I think the best way to just prep for whatever might come in the exam is to be comfortable with the questions in the assignments. And we'll also see once we start exam revisions how the questions have tended to be asked in past exam papers. But the questions in the assignment were not easy. Especially in the MBL 5903 paper. Question number 1 is not an easy question. So I want to take you through that question. And what made the question even tougher is that it wasn't communicated nicely. It wasn't communicated nicely. Once in a while, you get a question you struggle with, and the struggle with the question is not so much you not understanding concepts, but it's you not following what exactly is being communicated by the person who set the question. That sometimes happens with a lot of MBA and MBL 5903 questions. I found, given the time, the few years I've been helping people with these modules, they tend to be some questions which are just not communicated nicely. So that can actually impact your ability to find out what the person who was asking is actually asking for. So as you can see, it's a 42-mark question. It's a very, very long question. And I'm not sure if you actually add these marks, if they add up to 42. Let's see. This is 8 marks plus 2, that gives us 10, plus 4, that gives us 16, plus 10, that gives us 26, 26 plus 4, that gives us 30. Yeah, it's actually 40. So it's got a lot of marks. So let's go through this question. This question will just take you through the remaining part on capital budgeting cash flows. And then after that, we will look at some of the capital budgeting techniques that are left that you need to know. And also we'll touch on some concepts relating to capital budgeting cash flows, which are really important. Okay. So let's read the question. Merafe Mining is evaluating the possibility of adding a new product line to its product mix. Because the exercise requires a detailed analysis of all possible risk scenarios or cases, EY has been contracted to perform a capital budgeting analysis for Merafe. The new machine would cost Merafe 200,000 Rand, and a further 10,000 Rand would be required for shipping charges, and an additional amount of 30,000 Rand is estimated for installing the equipment. Assume an economic life of 4 years for the machinery, and it's depreciated, and the depreciation is based on MACRS 3-year class. Assume the following 3-year class depreciation rates: year 1, 33.33%, year 2, 44.45%, year 3, 14.81%, and year 4, 7.41%. The machinery is expected to have a salvage value of 25,000 Rand after 4 years. The new product line would generate incremental sales of 1,250 units per year for 4 years at an incremental cost of 100 Rand per unit, excluding depreciation. Each unit can be sold for 200 Rand in the first year. The sales price and costs are both expected to increase by 3% per year. Further, to handle the new line, the equipment's net working capital would have to increase by an amount equal to 12% of sales revenue. Assume the company's tax rate is 40% and the overall weighted average cost of capital, which is the risk-adjusted cost of capital for an average project, is 10%. And then we are asked a number of items. So number one says define incremental cash flow. I did talk about this slightly in the previous class, and I said in capital budgeting, we are concerned with the incremental cash flow. We are concerned with the change, with the new cash flow minus the existing cash flows. Okay, so we define the incremental cash flows as follows. The incremental cash flows are the additional cash flows, either outflows or inflows expected to result from a proposed capital expenditure. Okay, so when we talk about an incremental cash flow, we're talking about the additional cash flow, whether it be an outflow or an inflow expected to result from a proposed capital expenditure. So for example, if currently our cash flows amount to 200,000 Rand per year, our operating cash flows, let's say currently our operating cash flows amount to 200,000 Rand per year. If with a new machine, we expect these cash flows to go up to 300,000, right? The incremental cash flow would be 300 minus 100 minus 200, giving us 100. So when we're doing capital budgeting, we are concerned with this 100. We are not concerned with this 300 that we get from the new machine. Rather, we are concerned with the extra benefit of the new machine. Okay, what extra benefit is the new machine giving to us? So when we're looking at capital budgeting questions, when we calculate operating cash flows, we're calculating the incremental operating cash flow. We're trying to look at the extra benefit that a machine or a project gives us. And then we are working with the cash flows that result from that extra benefit. So we define incremental cash flows as the additional cash flows, either outflows or inflows, expected to result from a proposed capital expenditure. So this is very important. Capital budgeting cash flows is concerned with incremental cash flows. It's concerned with the change from the current cash flows we are receiving. Because let me just give you an example why this is the case. Suppose, like in the example I gave you before, suppose we currently have a machine giving us 200,000 each year in cash flows. And suppose we get a new machine and we expect that machine to give us 200,000 as well, right? These two cash flows, so this is current. Let's say this is current, and then this is the new machine, right? So you'll notice that these two, we can't just look at this 2,000 by itself, and we can't say that the new machine is giving us 2,000. The new machine is actually giving us nothing, because if we replace the current machine and we get the new machine, all we're actually getting is what? Is just the same 2,000 we had before. Yeah, so it means that the new machine is actually giving us nothing, because we had a current machine and then we replaced it and we got a new machine, and the new machine is just giving us 200,000. So we can't analyze this as a benefit, okay? Rather, what we can do, we can take whatever the new machine is giving us minus what the current machine is giving us, and we can analyze that. So it would mean that what we're actually getting from the new machine is zero, if it's just giving us the same cash flows as the previous one. That's why we are concerned with incremental cash flows. What's the extra cash flow that we're going to get from purchasing the new machine? And then 1.2 says, what is Mirafe's depreciable basis? And you're told what is being referred to in depreciable basis. It means which items are depreciable and what are the annual depreciation expenses, right? So in this particular case, the installed cost of the new machine is what's depreciable. The amount of money we spend as the installed cost of the new machine, this is the depreciable basis. And the depreciable expenses are as follows. Firstly, we calculate the installed cost of the new asset. Remember, we always base our depreciation on the installed cost of the new asset. We don't base our depreciation on the cost of the new machine only. We take the cost of the new machine, we add our installation costs, and we add our delivery or shipping costs. And then the answer we get is the installed cost of the new machine. So in this case, the installed cost of the new machine would be 240,000 Rand, right? And then we can use the MACRS percentages multiplied by the installed cost of the new machine to get our depreciation expenses for each year. You can also verify these calculations: 33.33%, 44.45, 14.81, 7.41, and then we get these depreciation expenses. Okay. Then the next part of the question, part 1.3, said, calculate the annual revenues and costs, and why is it important to include inflation when estimating cash flows? So we were told that our sales are 1,250. We were given the incremental cost per unit. You see the extra cost. They just didn't say cost here. And we were also given how much each unit can be sold for in the first year, right? Each unit can be sold for 200 Rand. And we were also given the incremental sales, the way our sales are going to increase per year for 4 years, right? And we were told that the sales price and cost are both expected to increase by 3%, okay? So we can apply those numbers in this particular question, right? So the way we do this, I created a table here. I created a table, and the table highlights for year one what we expect our revenue to be. We take the unit in sales times the selling price, we get that amount. We take the cost of sales times the cost price, and we get this amount. And then for each year, these values are increasing by 3%, right? It means our revenue is going to increase by 3% as a result of increasing this 200 by 3%. The same happens to the cost of sales. So we multiply by 1 plus 3%. Remember, if you're increasing something by a percentage, you multiply that item by 1 plus the percentage. So you see, we increase our revenue by 3%. We increase our cost of sales by 3%. So we keep doing that for each year. It's just a standard calculation. Remember, 3% is 0.03, so it's 1 plus 0.03. So we're also asked why we include inflation. It's important to include inflation because we are discounting the cash flows for this project using a nominal discount rate instead of a real discount rate. This weighted average cost of capital that we're going to use to discount our cash flows when calculating the NPV later on, it's a nominal discount rate. It's a nominal discount rate. All the discount rates that we're given in this module are nominal discount rates, right? So when we are using, and when we talk about a nominal discount rate, we're talking about the rate of interest how can I put this? Okay, look at it this way. A discount rate is made up of two parts. It's made up of the real interest rate plus the inflation rate, right? Yeah. A nominal discount rate consists of two parts. It consists of the real interest rate and the inflation rate, right? Money loses value because of inflation. So if you take this rate that investors are requiring and you subtract the effects of inflation, you are left with what investors are really earning, right? You're left with what investors are really earning, okay? So because we are going to be discounting our project using the nominal discount rate, which includes something extra for inflation, it means that we need to also increase our cash flows by the inflation rate, right? If the rate we had been given here was